Good evening, ladies and gentlemen. Welcome to our first property investment, trust and tax webinar for the year. We are extremely excited to share our wealth of knowledge with you tonight, as well as the IGrow wealth proposition. Over the last 16 years, IGrow have assisted many clients with their property investment portfolio. But first, I would like to introduce myself. My name is Jolandi Vermeulen. I'm a qualified and admitted attorney, and I've been with IGrow for 10 years. Later tonight, I will also introduce you to Cara Prins, our finance manager, who's going to assist you on the tax field of our webinar. So for 16 years, IGrow have assisted our clients to achieve financial freedom using property investments. IGrow has sold investment properties to the value of 10 billion rand, and we've got over 2 billion rands worth of property under our rental management. Our founder and CEO, Jacques Vermeulen, is passionate about property investment, and he's grown the IGrow group of companies to assist clients with their property investment journey. IGrow has got a fine group of companies with services best suited for any property investment portfolio. We've got the IGrow Wealth Investments that source A-grade properties for our clients. We've got IGrow Wealth Management that assists you with a plan of action to know which steps to follow to grow your property portfolio. We've got IGrow Chartered Accounting that assists our clients with all accounting needs. IGrow Wealth Home Loans that can assist you with applying for bonds at all the major banks. And currently, IGrow Wealth Home Loans is the third biggest bond originating company in South Africa. We've got IGrow Trust that will assist you to structure your portfolio correctly. IGrow Rentals that can assist you to place tenants and also to manage the rentals thereafter. IGrow Real Estate to assist you to sell the properties should that be the need. And then IGrow Digital Marketing that can assist you with all marketing needs for your property portfolio. In order to make a success of your property investment portfolio, there's a specific steps that you need to follow, and you need to make sure that you do it right from the start. Our CEO, Jacques Vermeulen, has created a 10 steps plan. And remember, it's important to follow these steps from 1 to 10 in the correct order, almost like baking a cake. If you don't follow the recipe correctly, your cake will be a disaster. And this is the same with your property investment. If you don't follow the correct steps, somewhere you're going to have a disaster on your hands. Step 1 of your property investment is to acquire the skills. Make sure you invest on your mind. And I think this is what you guys are doing tonight. So congratulations on that. Remember, you are going to be the CEO of your company, but that doesn't mean that you can acquire all the skills. Make sure that you have experts around you with the proper skills that can assist you. Step 2 is to build a team of experts around you. As I've mentioned before, you will be the CEO, but you need somebody that can assist you. Cara, clients are asking us to share screen. I'm not sure whether you guys can see it on your side. I can. Sorry for interrupting. Okay, so clients can see it. I think it's not on our side. Okay. So as I said, step 2 is to build your team of experts. Even though you will be the CEO of your company, you need experts to assist you because you cannot be the expert on all fields. For example, you need a great accounting team that can assist you to make sure that you make use of SARS in the best possible way so that you pay the least amount of taxes possible. Step 3 is to create a plan. Nobody can be successful in their property investment without a proper plan to ensure that you follow the steps correctly to become financially free. Our wealth management team can definitely assist you with that. Step 4, leverage. Make sure that you use other people's money, other people's time, and other people's knowledge to grow your investment portfolio. This is the only way that you will get ahead in your property investment strategy. Step 5 is the correct structures. Guys, this is something that we're going to elaborate on tonight, but it's in vital importance to have your property investment portfolio in the correct structure. Without the correct structure, you're going to pay exorbitant amounts of tax, as well as exposing your property portfolio to unnecessary creditors and estate costs. Step 6, select the right property. Make sure that you have A-grade properties that's going to have capital appreciation, but also a steady income stream for you from rental properties. Step 7, systems. Make sure you have the correct systems in place, systems that can assist you to manage your properties correctly. For example, our rental management team are using systems like Red Rabbit and PayProp, which gives you access to your properties on a 24-hour basis. You would be able to see if your tenants are paying, when they're paying, if they are behind, as well as making sure that all maintenance are done on your property timeously and correctly. Step 8 is SARS. None of us want to pay taxes, but unfortunately, it's something that's a reality. But by making sure that you have the correct accounting team, you can ensure that you pay the least amount of tax and get the best benefits from any deductions that is available to you. Steps 8 will be discussed by Cara Prins later on tonight in more detail, as we find this is in vital importance for you in your property portfolio. Step 9, rental management and maintenance. Guys, I think anybody that does property investments knows that this is very, very important. Without placing the correct tenants and making sure that they pay you every month, you're gaining from your property investment portfolio, because that's our main stream of income, rental income. So definitely make sure that you have a good rental management team on your side. And then step 10 is repeat step 1 to 9. You have to scale and grow your property portfolio. You can't just stop with one property. You need to repeat step 1 to 9 all the time to ensure that you can grow your property portfolio to lengths that I don't think even you are aware of. But as I've mentioned, we're going to concentrate tonight on step 5 of the 10 steps, as well as step 8. So step 5 is structures. In which entity do you buy your property investments? Currently in South Africa, there's 3 entities available. You can buy as an individual, you can buy your properties in a trust or in a company. And each of these entities have different benefits and negatives to consider. So let's look at all of them. If you look at buying as an individual, there's a few factors to consider. So the first factor that you need to consider is that any property that you purchase in your personal capacity is vulnerable to your personal creditors. If something should go wrong and you are ever sequestrated, your creditors would be able to attach and sell your property to settle your debt. And this is the case irrespective of whether the debt is related to the properties. So you might be sequestrated because you cannot pay your credit card debt. And now they attach and sell your properties to settle that debt, which is obviously not ideal. The second factor to consider is tax. If you buy properties in your personal capacity, the rental income will be received in your personal name. That rental income is added to your annual income and it's taxed at your marginal rate. So let's say your salary puts you at a 40% tax bracket. Any profit that you then make on the rental income is also taxed at 40%, and it can very easily push you into a higher tax bracket if you're not already at the maximum. So from a tax perspective, definitely not ideal. And then the last factor to consider is the cost when you pass away. For most of our clients, it's important that whatever you've accumulated during your lifetime, especially your property investment portfolio, you can leave that as a legacy, as an inheritance to your loved ones one day. Now, unfortunately, in South Africa, when you pass away, before anybody can inherit from you, there's quite a few estate costs that becomes applicable. I'm going to mention them to you guys quickly. So estate duty of 20% on all assets over the value of 3.5 million. So if you have a net to estate one day, let's say of 7 million, you would be able to subtract 3.5 million, and 20% estate duty will be applicable on everything above 3.5 million. So on 7 million, subtract 3.5 million. On the 3.5 that's left over, 20% to SARS. You're also looking at capital gains tax on all assets that grows in value, so typically property. So if you've bought a property today for R1 million, and by the date of your death, that property is worth, let's say, 3 million, it's grown in value with 2 million rand. And on that growth of 2 million, then SARS will charge you capital gains tax of between 13 to 18%. And then the last estate cost that you need to be aware of is executors' fees. This is something that is always payable. And currently the executors' fees is 4.0 to 5% of your gross estate. So if your gross estate is 10 million, your executor will take 4.0 to 5% of that. So I think, as you can see, buying as an individual is not always the best option. If we look at the second option, then buying in a trust, there's a few factors to consider as well. So the benefit of buying in a trust is you've removed the properties from your personal estate. No estate cost is applicable to the assets held in your trust. The second benefit of buying in a trust is that you've got full control over the assets still, because you will be the trustee of the trust. A very big benefit of a trust is that your minor children can inherit the trust. Remember, if your children are minor and you leave the assets to them out of your estate, it will have to go to the guardian's fund. With a trust, you avoid that because you then control the trust and you can one day nominate who needs to take care of this trust while your kids are still minors. A trust does not need to be audited. And as I've said, it helps to leave a legacy for your loved ones because the assets held in the trust doesn't go into your estate. There's, however, big disadvantages of the trust, and that is the tax rate of a trust. A trust is taxed at 45% from Rand 1. So if you have your properties in the trust directly and you receive the rental income, the moment that you make a profit, you're going to be taxed at 45%, which is obviously definitely not ideal. So the third option then is buying your properties within a company. A company also have a few factors and benefits to consider. The tax rate of the company is very attractive at 28%. It's normally lower than that of your personal marginal tax rate, and it's lower than that of the trust. The benefit of the company is also that the properties itself, because it's in the company, is protected from your creditors. You remain in control because you will be the director of this company. There's no auditing required for the company, and you can write off company expenses against the income from the properties before you are tax liable. The disadvantages of a company is that the shares of that company still needs to belong to somebody. So if you hold the shares of that company in your personal name, it still goes into your estate when you pass away, and all estate costs that I've mentioned as an individual will be applicable to the shares of this company. So what we recommend then is a company and trust structure, a combined structure, if I can put it like that. So we recommend that you purchase your investment properties within the company and that the shares of this company is then held within a trust. If you purchase the properties within the company, you also receive the rental income in the company. And when you make a profit, you tax in the hands of the company at 28%. So the biggest benefit offered by the company, that of the lowest tax rate, is then definitely achieved by buying the properties in the company. And how we achieve the benefits of the trust is by placing that shares, as I've mentioned, in the trust. By doing so, you avoid any estate costs and your properties are protected from your creditors. So combining the company and trust then definitely gives us the best of both worlds by the lowest tax rate, as well as protection from creditors and estate costs. But for now, I'm going to hand you guys over to Cara Prins. Cara is our financial manager. She's a qualified chartered accountant as well as a tax practitioner, and she's here tonight to discuss the tax treatment of property portfolios with you guys.
Thank you, Jolandi. Good evening, ladies and gentlemen, and welcome to the next section of our webinar related to taxation of property investment portfolios. I would like to start off by highlighting the importance of tax planning and structuring your portfolio in a tax efficient manner. So tax planning can look similar to the following strategy: is creating a tax strategy in order to take advantage of tax law. There are a lot of provisions that allow you to reduce your taxable income, and you can use all the deductions and tax incentives possible. Use qualified property investment accountants and tax practitioners. We see often that not all of the provisions in the tax laws are being used, or people are not aware of it. So it is good to have someone who sees this day in and day out, just to have a chat with them and see where you might be missing out and paying tax unnecessarily. As you know, individuals that earn salaries, for instance, use their after-tax money, to buy their usual day-to-day expenses. But property investments that operate their property portfolio as a business can buy more property eventually with their before-tax money. So they operate their business with before-tax money because your expenses are deducted even before you pay your tax. So investments in property that qualify for tax deductions as stipulated in Section 13(6) of the Income Tax Act is something that can be applied in your tax planning of your property portfolio. So just to give you an example, when you run your property portfolio as a business and you really do plan from the start, what you should be aware of is that you've got your income, you deduct all your expenses related to your business. For instance, if you have a property that you rent out to tenants, all your expenses related to that can be deducted, and then you calculate your net income. You have further possible deductions like the Section 13 building allowance, and then you calculate your tax on that. So it's very important to realize that, yes, you want to lower your taxable income and you want to pay as little tax as possible, but always remember that you shouldn't always just look at the tax implications. Also take into consideration that you want to grow your business. So if you have to make a decision, always make sure that you make a commercial decision for your business, what's best for your business. And if that aligns with a very good tax strategy, that would be the perfect scenario. Okay, so I'm going to introduce you now to some of the tax deductions that we generally see in a property portfolio. This would most likely be in a company that has its own bank account. All of the income and expenses go through that bank account, and the accountant can, for instance, do a complete and accurate calculation and bookkeeping in order to do the annual financial statements, which is the basis for the tax calculation that is submitted to SARS. Firstly, your rental income is something that you have to declare, and it will, if the portfolio is structured in a company, the rental income will probably go into the bank account of the company. And if there's a rental agent, they will send rental statements, for instance, via PayProp, which is a really great system, and it'll keep track of all your rental income. But you don't pay tax 28%, for instance, on the rental income. You have the advantage of deducting all your expenses related to renting out this property first. So that could be expenses like your levies, rates and taxes, anything related to the properties that you are renting out, you can deduct that. Any repairs and maintenance, that is all deductible expenses. If something breaks in one of your tenanted properties and you have to fix it, and you can deduct that from your rental income as well. Any other expenses that someone might forget about. So for instance, let's say someone has a property portfolio in their personal name and everything goes through their personal bank account. It's very easy for them to forget to take all of these expenses into account, because it's just sometimes very difficult to completely find each and every of those transactions. So it's very important, if you have a property portfolio, regardless of in which structure, it's very important to keep track of each and every expense related to that business that you are essentially running. That could be administration fees, professional fees, accounting fees, certain legal fees. For instance, if you want to evict a tenant that's not paying their rent, bank charges on the bank account that you have opened specifically for the business, employee costs. So if you spend a lot of time on your property portfolio as the director of a company, of that property portfolio company, then you can have the company pay you a salary for the work that you are doing in the form of a director or an employee of the company. Traveling costs. So if you have a property that are across the country and you want to travel there to do an inspection or meet with a new tenant or rental agent, then those traveling costs are tax deductible. Another good tax deduction that we see is properties that are financed via a home loan have monthly rental repayments. So there are two parts of those repayments. You've got the capital portion of the bond repayment and the interest expense portion of the bond repayment. In the initial stages of the property investment, we usually see that the proportion is much more interest expense than the capital portion that are being paid off. So there's a large interest expense that is tax deductible. And that interest expense could really reduce the taxable income, especially in the first few years of the property portfolio. Wear and tear allowances are also tax deductible, so that's something that should also be taken into account, and that could even be furniture and fittings. So now we get to a SARS tax incentive that not everyone is aware of, and it is a really great tax incentive to incorporate into your tax planning. And it's very important to be aware of this when you decide which properties to buy, because it might, and I'm using the word might because it's not necessarily always something that someone would need, but we would advise someone to look at that before they make the decision, because they might want to make use of this tax deduction, because I'll show you a bit later on what the impact of that could be. So this SARS tax incentive, what is it? SARS gives you a deduction against tax. How? Investors with 5 or more qualifying investment properties get a write-off of 55% to 100% of the cost of the property over 20 years. That is a very large deduction that you get in addition to all of the other deductions that you can utilize in your tax calculation. So the benefit is essentially that you lower your taxable income, you pay less tax to SARS, and generally, when you look at it realistically, if properties are bonded, in the first few years, it is very possible that the property portfolio might not be cash flow positive in year 1 or 2, but eventually when it does become cash flow positive, you don't need to start using this tax incentive at that stage. You can actually start using the tax incentive in year 1 as soon as you qualify, which means that you could have an assessed loss that you could carry forward up until the time that you become cash flow positive. And even being cash flow positive, because of the assessed losses that are carried forward, the entity can start paying tax a lot later than it starts turning a profit. So the requirements for this Section 13 building allowance deduction is that the portfolio needs to have 5 properties that are residential units owned by one individual or entity. In other words, if you've got 3 properties in your personal name and 2 properties in a company where you might be shareholder or you might be trustee of a trust that hold the company shares, that unfortunately doesn't mean you qualify. You or the company needs to hold 5 properties. It needs to be new, not previously occupied. In other words, if you buy property from someone else and there was someone who stayed in the property after it was built, that means that it's not part of the Section 13 requirements. And it needs to be used as a business, for instance, residential letting. So if you have 4 properties that could qualify, but the 5th is your primary residence, then it's most likely not going to qualify yet. So the deduction available, how it works is where you've got 5 residential units owned in South Africa. The cost that is calculated as follows. It's 55% of the acquisition price where a new unit is acquired, or 30% of the acquisition price where an improvement is acquired. So that means any improvement to an existing residential unit, you could multiply that by 30%. In order to get the cost which you base your next portion of your calculation on. So the next portion of the calculation is you take that 55% of the cost, for instance, multiplied by 5% of the cost calculated above. It is deductible from the taxable income per year. So that 5% can be deducted over 20 years. There's also a low cost accommodation option, but I'm not going to go into detail on that today. Section 13 benefit, to give you an example, is if you have a 5 million rand property that you purchased and your portfolio qualifies in terms of Section 13 building allowance, then your annual tax write-off can be the 5 million times 55%. And essentially it's divided by 20 years or it's multiplied by 5%, which gets you to a deduction of 137,500 Rand from your actual taxable income, which could have a very big impact if you have, for instance, a taxable income or a net profit of 100,000 Rand. That would mean that it would take you over to an assessed loss in a year and you won't need to pay tax on it. So if you multiply that times 28%, the effective amount at which you save tax on is 38,500 Rand. So that is set off against your taxable income. A practical example of what I meant earlier regarding paying tax a bit later than the company starts turning a profit is you will see in year 4, for instance, next to net profit or loss, that entity starts turning a profit. But you will see in the previous years, it wasn't cash flow positive yet. It had a loss, but there was a Section 13 building allowance deducted, and that resulted in year 1, for instance, in a total assessed loss of -3. That gets carried forward to the next year, and the Section 13 deduction is utilized again. The assessed loss of the previous year is utilized, and that all builds up to an accumulated assessed loss in the next year. So in year 4, when it starts turning a profit, the previous year's assessed losses are utilized to reduce that taxable income and carry forward an assessed loss even further. So eventually, when there is a larger profit, it takes longer for the entity to actually start paying tax, even if there was an actual profit earlier. So the 3 positive effects of Section 13(6) is that you pay less tax, your taxable income reduces drastically, resulting in lower tax, and your return on investment naturally increases as a result of you not having to pay tax in year 2, 3, or 4, for instance. And this is all an example, meaning that in those years where you normally, if you didn't have the Section 13 advantage and you weren't able to carry forward your assessed losses, you would have already started paying tax, and that would have technically reduced your return on investment. But because you don't have to pay tax that early on, because of the provisions in the Income Tax Act that you're applying, your return on investment naturally increases. And it reduces your shortfalls, because eventually when you have a situation where you don't yet need to pay tax and you can decide to use that cash for something else, then you are able to do so. Okay, so we've gone through the recommended structure and the tax implications of a property portfolio. One of the other value propositions that IGrow has is that cash investors can invest in property, and it is part of our exclusive and VIP cash investors portfolios. So the benefits would be that you get on the VIP list and invest first prior to public release. You become a pure lender or funder, or retain units on 15 to 20% below market, which is a much lower amount than you would expect to pay for the market value of the properties. And only a limited number of people are, or entities or properties are available per development. So you're welcome to get in touch with us if you have any questions. I could see that there were a few hands raised. A lot of the items we mentioned today in Jolandi's structures that she recommended, and also the tax implications, we go into detail in consultations and tailor it to a specific client's needs. And we look at what they are able to afford and what they are looking for specifically and what they would like to invest in, and then help with a specific structure. And we always have a lot of questions in those consultations that are very specific to someone's needs and their current structure that they might already have. So you're welcome to reach out to us. Our contact details are on there. Our number is 021 979 2501. We also have email addresses listed here. You're welcome to visit our website if you would like to know more. And I think that is it for tonight. If you would like a free consultation, you're welcome to let us know. And thank you so much for your time this evening, and enjoy the rest of your evening.